Bismillahirrahmanirrahim. In the previous class, we discussed about the definition of dividend, that what is dividend. I told you that dividend is that portion of profit of the company which is distributed among the shareholders. So that portion of the income or the profit of the corporation that is distributed among the shareholders. So now today we are going to discuss different forms of dividend payments. The first one, it is a regular cash dividend. There are some companies which are paying dividends regularly. Regular means there will be payment of dividend, but it will be on continuous basis. Like suppose a company is paying dividend annually, or a company is paying dividend half yearly, or a company is paying dividend quarterly. So every quarter he will pay dividend. Every 6 months he will pay dividend. Or every year he will pay dividend. The company will pay dividend. So a dividend that is paid on regular basis. Continuously we are paying that dividend. Most American companies pay regular cash dividends quarterly. That they are paying dividend quarterly. Every quarter they are paying dividend. Some pay dividends semi-annually or they pay dividends semi-annually. Johnson and Johnson, the pharmaceutical company, pays quarterly dividends, and McDonald's pays an annual dividend. Here is an example that Johnson and Johnson, they are paying quarterly dividend. After every 3 months they are paying dividend. And similarly McDonald's, they are paying yearly dividend. After every year they are paying dividend. The second one, okay, there is a payment, there is a journal entry for paying the dividend. So in that case, the journal entry, you can pass this journal entry in two ways. Here is the example. On February 1, ABC International's Board of Directors declares a cash dividend of $0.50 per share on the company 2 million outstanding shares. There are 2 million outstanding shares to be paid on June 1 to all shareholders of record on April 1. On February 1, the company records the entry. Keep in mind, one is the announcement date and one is the payment date. So announcement date, it is on February 1, and payment date is April 1. Means within February, March, within 2 months, the company will pay dividend. So one entry is for announcement of dividend. That is on January 1. January, February. Sorry. It is on January 1. Sorry, February 1. So on Feb 1, the company will announce dividend. So for announcement of dividend, you will debit retained earnings or you will pay dividend. You will debit dividend. So these are two methods. You can debit retained earnings, so it is 1 million. And you will credit, because on this date just we announced dividend, we didn't pay the dividend. So this dividend will become a liability on the company, and the name of this liability will be dividend payable. We are not paying cash. If you paid cash, then cash will be credited, but still we didn't pay cash. We just announced dividend. This is announcement. When dividend is announced, it will take too much time because there are 2 million shareholders. There is just announcement of dividend. So when dividend is announced, dividend will be debited and dividend payable will be credited by 1 million. So this will be the journal entry when dividend is announced. Either you will debit retained earnings because we paid the money from the retained earnings, or we paid dividend. So simply dividend debit and dividend payable credit. On April 1, within 2 months, company will try to pay all the dividends to the shareholders. So on April 1, now company will pass another entry, this liability, because we paid dividend, so this liability will be finished. So dividend payable will be debited because we paid the liability, 1 million. And now cash is gone, so we will credit cash by 1 million. So these are the journal entries when the company is paying dividend. Now there is a second type of dividend that is called extra dividend, special dividend, or interim dividend. Now those companies which are paying regular dividend, now sometime if the performance of the company is good, then what are they doing? They are paying extra dividend. Suppose McDonald's, writing shortly, McDonald's, they are paying regular dividend yearly. Suppose on Feb 1, they announce dividend, Feb 1, and we pass this journal entry. Now what happened? The performance of the company was good, so what the company did in July, they announced another dividend. This type of dividend is called interim dividend, special dividend, or extra dividend. One is their regular dividend. This is regular. And except the regular dividend, the company paid additional dividend during the year. 2 times dividend is paid. So one dividend is your regular dividend and the other one is extra dividend or additional dividend. This type of dividend is called interim dividend, extra dividend, or special dividend. A dividend paid in addition to the regular dividend. An extra dividend is an additional non-recurring dividend. You are not paying this extra dividend again and again. This is non-recurring, not happening again and again. Regular dividend, it is recurring. We are paying it regularly. But this dividend, this extra dividend, this is non-recurring dividend paid over and above the regular dividends by the company. Like Microsoft Corporation paid $2 to its shareholders in 2004. In 2004, Microsoft paid additional $2 dividend to their shareholders. For example, Genentech Incorporation issued a special cash dividend of $31 per share paid on March 16, 2005 in order to restructure towards a more debt-based financing mix. What does it mean? Genentech, what they did, they paid the money to the shareholders and they took loan. You know that debt financing is better than equity financing. So they followed this policy and they returned the money to the shareholders and went towards the debt financing. They return the equity and they follow the debt financing policy. For this purpose, they paid additional dividend. Now the third type of dividend, it is called stock dividend. Stock dividend is a type of dividend that is not paid in the form of cash. That is paid in the form of additional stock. A stock dividend is the issuance of new stocks to its common shareholders without any consideration. Without any consideration means we are not demanding cash from them. We are giving them shares free of cost. If the company issues less than 20% of total number of previously outstanding shares, you treat the transaction as stock dividend. This would normally be done in place of paying a dividend. Now, what does it mean? It is not good to pay cash. Company needs money. Company is in need of money for expansion or maybe for some other reason. The company want to expand their operations. So if they will pay dividend in the form of cash, so there will be a cash outflow and it will be difficult for the company to expand. So what are they doing? Instead of paying cash, they are giving them shares. Suppose the company is regularly paying a dividend of $1. So now they are not paying cash. They are giving them a share whose value is $1. Additional stock of $1 and they are not demanding any cash. They will not demand cash. Just they will pay them, they will give them additional dividend. So this form of dividend is called stock dividend. So a stock dividend is the issuance of new stocks to its common shareholders. They are giving them stocks, but without any consideration. They are not demanding any cash. Suppose you are a shareholder, A, this is A. The company is regularly paying $1 dividend to A. So this year in 2019, the company will pay $1 to Mr. A. But instead of paying this $1, they are giving Mr. A this share. That take this share and don't demand any cash dividend. So what will be the journal entry for cash dividend? Sorry, stock dividend. Retained earning, here is an example. ABC International declares a stock dividend to its shareholders of 10,000 shares. The fair value of the stock is $5 and its par value is $1. ABC record the following entry. Now there are 10,000 shareholders and company declares a stock dividend. The market value of the share in the stock market is $5, but the par value is $1. So what is company doing? There are 10,000 shareholders. So 10,000 multiplied by 5, so it will become 50,000. So mean they retained $50,000. And they issued common stock $1, 10,000, and additional paid in capital 40,000. Understand this? Not difficult. There are 10,000 shareholders. The company announced stock dividend and the market value of stock, it is $5, but its face value, it is $1. So they issued additional stock. The value of this stock, it is $5. Now total number of shareholders 10,000. So 10,000 multiplied by 5. So our retained earnings, it will be 50,000. 10,000 multiplied by 5. Now out of this, the face value, here look at the face value. The face value is $1. So here common stock will be credited by 10,000 and the additional amount of 40,000, which is in the form of cash, not in the form of stock, not in the form of cash. That is additional paid in capital. I'm writing shortly. So additional paid in capital. So this will be journal entry for the issuance of stock dividend. Liquidating dividend. Liquidating dividend, it is the fourth type of dividend, and a dividend paid to shareholders out of a company's capital or assets rather than its earned income. Mostly this is the policy that company will pay dividend out of the profits, but sometime if the performance of the company is not good and they didn't pay dividend from previous 2-3 years, so what are they doing? They are paying dividend from the capital of the company or from the assets of the company. They are selling the assets or they are paying the capital to the shareholders. A type of payment made by corporations to its shareholders during its partial or full liquidation, or the company is partially liquidating or fully liquidating. Partial liquidation means they are selling a portion of the operation of the business, or they are selling the whole business, full liquidation. So that type of dividend, it will be called liquidating dividend. This usually happens when shareholders believe that the company is no longer suitable or profitable. When the shareholders believes that now the performance of the company is not good and the company will be not profitable in the future. So now in that case, the company is selling all the assets of the company and paying the money to the shareholders, returning the money to the shareholders. All of the firm's debts must be paid before it can pay liquidating dividend. But before paying the liquidating dividend, they will pay the debts, the liabilities of the company. Now keep in mind, liquidating dividend is paid when the company sell its portion of operation, or a company is selling all the assets, or the company is fully liquidating, or the company is fully selling their assets. So in that case, if all the assets are sold, company is going to liquidate, then in that case, first priority will be given to debt holders. First, debts of the company will be paid. Then, preferred stockholders' claims will be satisfied. And then, if something is left, then liquidating dividend will be paid to common stockholders. We discussed this thing in preferred and common shareholders. So this type of dividend, this is called liquidating dividend. There is another type of dividend that is called scrip dividend. What is scrip dividend? A company may not have sufficient funds to issue dividends in the near future. So instead, it issues a scrip dividend. What does it mean? Scrip dividend means that they are promising the shareholders, they are making a promise with shareholders that we will pay you dividend after 6 months. Don't demand dividend now. We will pay dividend after 6 months. This type of dividend is called scrip dividend, a promise of the company to shareholders that we will pay dividend to you after 6 months. A company may not have sufficient funds. They don't have funds to issue dividends in the near future. So instead, it issues a scrip dividend, which is essentially a promissory note, which may or may not include interest. Maybe it will include interest, this promissory note, or maybe it will not include interest. To pay shareholders at a later date, this dividend creates a note payable. Now, this dividend will become a note payable. That is, retained earnings or dividend will be debited, and notes payable will become credit. Previously, it was dividend payable, but now it becomes what? Notes payable, because it is a promissory note. Promissory note is a liability. So, notes payable, but there is a written evidence that you will pay dividend. So, this dividend will become a note payable. And keep in mind, maybe it will have interest. Maybe the company will pay interest on this notes payable. ABC International declares a 250,000 scrip dividend to its shareholders that has a 10% interest rate, and they will also pay 10% interest on this $250,000 at the dividend declaration date. It records the following entry. This is dividend declaration date. So retained earnings 250, notes payable 250. When they will pay dividend, so at that time notes payable will be debited and cash will be credited. And if there is interest on that, so notes payable, what is the amount of notes payable? 250,000. and there is 10% interest, so there will be interest expense. Suppose that interest expense, this is 10%, so 2,50,000. Suppose after 1 year the company is paying dividend, so 10% will become 10 divided by 100, this, so it will become 25,000 interest on the dividend on the promissory note, and they will pay cash, which is 275,000. So this will be the entry when interest plus dividend is paid to the shareholders. There is another type of dividend that is called dividend in kind or property in kind dividend, very rare dividend. Dividend in kind are paid when the corporation distributes asset such as any property, asset, finished goods or stocks. They are paying either some finished goods in the shareholders, stocks of the shareholders, stocks of the company, any property or any assets. So this kind of dividend is called, they are not paying cash. They are just distributing the property or the finished goods or whatever that is. This type of distribution occurs when cash is not readily available or allocation of other assets is better as compared to the cash outlay. This is allocation. Allocation of other asset is better as compared to the cash outlay. Means it is beneficial for the company to distribute the assets as compared to the cash. So in that case, the company is paying property dividend. So these are different types, different forms of dividend, 6 forms of dividend. Now we are going to discuss another topic that is called DRIP, Dividend Reinvestment Plan. What is dividend reinvestment plan? A dividend reinvestment plan allows shareholders to reinvest their dividends in additional stock rather than receiving them in cash. These plans are offered directly by companies or through agents acting on behalf of the corporation. Now, what is company doing? When company is paying dividend, this dividend is in the form of a check, like this check. Amount will be written and name will be written. This is called dividend warrant. Now what is company doing? They are personally offering the shareholders that don't withdraw the cash. Instead, reinvest this cash in the shares of the company. Don't withdraw, reinvest it. Reinvest this money in the shares of the company. So this is called dividend reinvestment plan. The company is doing this thing either themselves or through their agents. And agents can be what? Because you are receiving cash from a bank. So maybe the bank will motivate you to reinvest this money in the stocks of the company. The other type of plan is offered by agents such as banks that collect the dividends and offer additional shares to shareholders who sign up for the plan. Maybe a bank will be an agent and bank is motivating you that reinvest this money, we will give you additional shares. The bank pools the cash from dividends and purchases the stock in the secondary market, and then bank from all the shareholders which are motivated that they will reinvest their money in the shares, so bank is purchasing shares on behalf of them. So this is called dividend reinvestment plan, that you are not withdrawing money in the form of cash that is given to you as a dividend, and instead you are reinvesting this cash in the shares of the company. So this is the end of chapter. Inshallah, in the next class then we will discuss about lease and its types. Assalamu alaikum.